What if the next housing crash isn't triggered by Wall Street but by City Hall? Because somewhere inside a set of government spreadsheets, a warning is flashing red. Treasury filings, census data, and city balance sheets quietly reveal something no real estate model, especially not Zillow's, was built to see. A 2026 housing crisis that doesn't begin with subprime loans or bank failures, but with the collapse of America's local finances. Here's the hard data no one's talking about. Dallas, Texas is sitting on a $5.9 billion structural deficit. Austin owes $3.9 billion in unfunded obligations. And Florida, the supposed golden land of migration-fueled real estate, has already lost $109 billion in housing market value in a single year. Zillow's August 2025 forecast still calls this stabilization. They see only modest declines, 1.2% nationally, 3% in Austin, 6% in Dallas. But buried in government reports is a different story. The kind that doesn't show up on glossy dashboards or AI models. The kind that smells like a slow-moving financial fire. Because these aren't just housing numbers, they're fiscal time bombs. Every 1% fall in Dallas property values wipes out roughly $11 million in city revenue. That's money meant to fund police, schools, and infrastructure. When property values fall, tax revenue vanishes. When tax revenue vanishes, cities cut services, confidence erodes, and home prices fall even faster. A feedback loop of financial decay. Yet the public doesn't see it. They see Zillow graphs and think the market will cool. They don't see the accountants behind closed doors quietly admitting the math no longer works. So how did we get here? How did entire cities end up dependent on ever-rising home values to stay solvent? To understand why the next housing crisis won't start in banks or mortgage desks, but inside local governments, we need to go back in time. To the years when cheap money, migration booms, and blind optimism convinced America that growth could never end. And that illusion is exactly where this story begins. To trace the roots of the 2026 housing crisis, we have to return to the aftermath of another collapse, the Great Recession of 2008. America rebuilt itself on debt and denial. The Federal Reserve slashed interest rates to near zero. Trillions in stimulus flooded the economy. And cities, desperate to recover tax revenue, began chasing growth at any cost. By the mid-2000s teens, a new religion had taken hold in city halls across America. Growth equals solvency. If property values rose, budgets would balance. If new homes went up, pension gaps would vanish. It didn't matter whether that growth came from speculation or stability, so long as the charts pointed upward. Nowhere did this illusion burn brighter than in the Sun Belt. Between 2015 and 2023, Texas added more than 4.3 million residents, more than any other state in the nation. Cities like Austin, Dallas, and San Antonio responded with reckless optimism. They borrowed, built, and expanded their bureaucracies on the assumption that tax revenues would never stop rising. Dallas's annual spending more than tripled in less than a decade. Austin's pension obligations ballooned past $3.9 billion, even as home prices soared 40% in 3 years. Then came the pandemic. In 2020, low interest rates and lockdown migrations triggered the greatest housing boom in modern memory. Remote workers fled the coasts for cheaper, sunnier metros. Texas, Florida, and Arizona became the promised lands of easy profit. Builders rushed in, city budgets swelled. Everyone believed the good times would last. But every boom plants the seed of its own destruction. By 2022, inflation was surging. The Federal Reserve began the most aggressive rate hike cycle since the 1980s. Mortgage rates doubled in a year. Suddenly, the very engine that fueled the Sun Belt miracle began to sputter. Behind closed doors, city treasurers saw the numbers turning. Debt service costs rose, sales taxes flattened, construction slowed. But the public narrative stayed rosy because acknowledging the truth meant admitting that the foundation of local prosperity was built on borrowed time. Zillow's forecasts still showed soft landings, but city accountants were already whispering about fiscal cliffs. They knew what was coming, a silent, systemic reckoning. And as the tide of cheap money receded, the illusion cracked. The first warning signs appeared not on Wall Street, but in city ledgers across Texas. The turning point was about to arrive. By 2025, the illusion of perpetual growth shattered. What had looked like a soft correction became something far more dangerous, a fiscal contagion spreading through America's fastest-growing cities. The evidence was hiding in plain sight. According to the U.S. Census Bureau, single-family housing permits dropped 7.2% in Texas and 11.9% in Florida that year. Home builders weren't slowing down because of demand, they were fleeing collapsing economics. In Houston, 4,532 fewer homes were approved than the year before. Austin cut 4,240. Even Phoenix, once the poster child for post-pandemic migration, fell by more than 5,000 units. Zillow's models called these minor adjustments. But builders weren't reading Zillow. They were reading city budget reports, and those reports told a different story. Dallas, for example, faced a $5.9 billion structural deficit, not a one-year hole, but a long-term imbalance baked into its books. Property taxes brought in $1.1 billion, yet just two departments, police and fire, consumed more than $1.2 billion. Every percentage point of home value decline erased $11 million in city revenue. And those home values were declining. Zillow projected a 3 to 6.5% fall for Dallas, and the city's financial math imploded overnight. Austin's nightmare followed close behind. After years of double-digit appreciation, the city logged its first property value drop in recent memory, just as it faced $3.9 billion in unfunded pension obligations. Officials floated a desperate 20% property tax hike for November 2025. If voters approved it, residents would flee. If they rejected it, the city would face service cuts and layoffs. Meanwhile, Houston, once the energy capital of America, was quietly bleeding out. The city's $4.5 billion deficit sat trapped behind a local revenue cap that made tax increases illegal. Employment fell nearly 1% by mid-2025. The city was balanced only on paper, patched with one-time federal aid and accounting tricks. This wasn't just a housing slump. It was a fiscal feedback loop. Falling property values, starved city revenues, forcing service cuts, which further eroded property values. And yet the story was only half written. Because while the Sun Belt was sinking under its own weight, something strange was happening hundreds of miles to the north. New York and Connecticut, places investors had abandoned years ago, were rising again, quietly, unnoticed. The surface story was about migration and demand, but the real secret lay beneath the census tables. To find it, we need to follow the money and the people moving in ways no economist expected. Everyone thought the Sun Belt story was unstoppable. Florida, Texas, Arizona, the land of warmth, freedom, and cheap square footage. But the numbers now tell a very different story. According to U.S. Census Bureau data for 2023 to 2024, Florida gained 467,000 new residents. Sounds like a boom, right? But only 82,000 came from other U.S. states. The rest, over 411,000, were international migrants, most with far lower buying power. The migration miracle had quietly flipped. The domestic inflow that once drove sky-high home prices was drying up. Texas followed the same pattern. Of its 562,000 new residents, just 85,000 came from other states, while 319,000 arrived from abroad. The high-income refugees from California and New York, who once fueled bidding wars, were now a trickle. The new arrivals weren't homebuyers. They were renters, laborers, families, starting over people essential to the economy, but invisible to the real estate algorithms. Meanwhile, New York City, the pandemic's poster child for urban flight, suddenly roared back. The metro gained 213,000 people, the largest jump in the nation, after losing nearly 300,000 only a few years before. Connecticut, once written off as stagnant, added 32,000 residents, powered entirely by international migration. This was the turning of the tide. The Sun Belt's domestic migration boom was ending just as its debt-fueled building spree peaked. The Northeast's chronic scarcity was becoming its greatest strength. But the deeper mechanism isn't migration. It's fiscal gravity, the invisible force that pulls every city toward balance or collapse. Cities that overbuilt now face a paradox. The more they depend on property values for revenue, the faster they fall when those values drop. Each decline triggers higher taxes or fewer services, which drives out more residents, which drives prices lower still. And yet, in places like New York and Connecticut, scarcity shields value. Years of zoning resistance and budget austerity mean limited supply. Fewer permits, fewer homes, but paradoxically, more stability. This cycle isn't new. America has seen it before. The 1970s urban rebound after the oil shock. The Sun Belt overbuild of the 1980s. Every era repeats the same pattern. Easy credit, migration hype, overextension, then collapse. Which brings us back to 2026. The stage is set, the data is written, the mechanism is in motion. But the cruelest part of the story is still ahead because this time, the fallout won't start on Wall Street. It will start in the streets, in schools, in police departments, and in the budgets of cities that bet everything on eternal growth. And when that bet fails, ordinary homeowners will pay the price. By the start of 2026, the pattern is unmistakable. The so-called soft landing has turned into a fiscal reckoning. Cities that built their futures on booming property taxes now face the kind of collapse once reserved for Wall Street banks. Dallas, Austin, Houston, Tampa, each believed rising home values could paper over growing pension debts and bloated spending. Each is now trapped in the same vicious cycle. As property values fall, revenue evaporates. To fill the gap, taxes rise, residents leave, services crumble, prices fall further, a spiral with no easy exit. The cracks are already visible. Dallas's $5.9 billion deficit is widening as property tax collections lag behind police and fire costs. Austin's proposed 20% tax hike threatens to drive out the very businesses that once made it a boomtown. Houston's revenue cap, meant to protect taxpayers, now prevents the city from saving itself. Even Florida's dream markets are unraveling. The state lost $109 billion in home value last year. Insurance premiums are exploding. Homeowners are walking away from underwater mortgages, just like they did in 2008. But while the South struggles to stay afloat, the Northeast is quietly thriving. Connecticut, the same state that nearly went bankrupt a decade ago, is projected to see 20% growth in multifamily prices. Why? Scarcity. Fiscal restraint. Decades of tight zoning that limited construction. The very conditions once mocked as anti-growth are now its greatest defense. This paradox lies at the heart of America's housing future. The more a city relies on rising property values to survive, the more fragile it becomes. The more it resists that dependence, the more stable it remains. History already told this story. In 1975, New York City nearly defaulted under the weight of its own promises. In 2013, Detroit declared bankruptcy after property values collapsed. Both times, the real estate market wasn't the cause, it was the casualty of deeper fiscal rot. The same pattern is unfolding again, only this time it's national. Because Zillow can't model civic desperation, algorithms can't price political choices, and investors still mistake affordability improvement for opportunity. But what's really happening is the silent transfer of risk from government ledgers to homeowners' balance sheets. Ordinary people will pay for the debt cities refuse to confront, not through bailouts or foreclosures this time, but through rising taxes, shrinking services, and eroding neighborhoods. And that is the hidden truth behind America's 2026 housing crisis. It won't begin on Wall Street. It will begin in City Hall, in the quiet tick of a spreadsheet no one reads, until one day the math breaks and the illusion of endless growth finally dies.